The most critical date this year may be the last day of June, when $6.5 trillion in U.S. government debt matures. Most of this debt was borrowed during the pandemic at ultra-low rates. But now the Treasury has only a few hundred billion in reserves, far less than needed to repay it. To cover the gap, the government must issue new debt to refinance the old. Since this debt was first issued, interest rates have climbed to around 4.5%. Imagine borrowing $1 million at 0% interest, spending it, and now needing to refinance at a much higher rate. That's more than $200,000 in interest over 5 years. The U.S. faces this dilemma on a massive scale. Previously, investors eagerly snapped up U.S. Treasuries at low rates, viewing them as risk-free assets that tended to rise in value. Some used heavy leverage, buying $56 million in Treasuries with just $1 million in cash. But since March 2020, bond prices have dropped, and major holders like China and Japan have been selling. As bond prices fall, leveraged investors face margin calls, forcing more sales and driving prices even lower. This creates a vicious cycle, whereby even risk-free assets suddenly seem risky. This situation is like owning an aging house. You can patch it for only so long before repairs become unmanageable, forcing you to rebuild from scratch. The U.S. faces a similar dilemma. Continually refinancing and paying higher interest on its debt is just patching the cracks. Eventually, a major reset may be needed, which could spark global economic turmoil similar to 2008 before recovery can begin. What could trigger this?